Hello, Finance C22. I'm back. I apologize. I was actually intending on cutting these up into smaller chunks. And when I realized, I was like, I've been going on for quite a while. And so really, there's only about 10 slides left of chapter 18. And so I just want to wrap those up for you now. And so I'm going to turn off my projector so that I can write on our PowerPoint. So we kind of left off last class or last video, all right, when we were talking about purchase price parity. Right? And so we're basically going to take that concept and we're going to continue with doing covered interest arbitrage. All right? And so with that, let me share this screen with you. It's kind of the same aspect that we did with the foreign currency arbitrage earlier. And so when we're using covered interest arbitrage, we're capitalizing on the interest rate difference between two countries while converting the exchange rate with a forward contract. All right. And so if you remember the difference between the spot rate and the forward contract is really the difference in the inflation rates of the countries involved. And so let me click down here. Okay. So examples of covered interest arbitrage. All right. And so consider we have the following information. All right. So we have the spot rate, okay, of Swiss francs to the US dollar. Okay. We have the future rate, okay, of 1.9 Swiss francs to the dollar, all right? And we have the interest rates of both the US and Switzerland, all right? And so what is arbitrage opportunity, okay? And so it's very similar to what we did with the foreign currency arbitrage, but we're really just looking at the interest rates. And so interest rates, all right, really is the cost of financing using debt, right? And so what we're going to do is we're going to borrow $100,000 or $100, okay, US, okay, and we're going to have 10% interest on that. Okay. So we take that $100, we convert it into Swiss francs, okay, and so it was a 2-for-1 basically, and so we end up with this 200 Swiss francs. We're going to take that Swiss francs and we're going to invest it, all right, at 5% for 1 year. Okay, so if you think about this, right, we have double the Swiss francs, okay, and it's half of the interest rate. Okay. But we enter into a contract, all right, where we have the Swiss francs in 1 year, okay, that we can take $1.90 of Swiss francs and convert that into US dollars. So a year later, okay, we take our investment, the $200, all right, times the interest rate, okay, 5%. And so we have 210 Swiss francs. We take that and we convert the 210 back into US dollars, okay, using the futures rate. Okay. And so we end up with 110.53. Okay. Well, we repay the loan, okay, so remember we had borrowed this $100 up here at 10%, okay, and so we owe, okay, $10 of interest, and what this allows us to do is to earn 53 cents completely risk-free. All right. Now, the reason for this generally has to do with the slowness, okay, of the change in the futures rates, okay. And so if you can find these areas without having any risk at all, you can actually make 53 cents. 53 cents doesn't sound all that much, but hey, do the same thing because it's risk-free, right? It's risk-free. Okay. So do the same thing, all right, with $1 million, all right, and you could obviously make what is that, $530,000. I think I got my zeros at probably $53,000. Right. And so here they're just basically doing the same thing. We borrowed, right, the $100, 100 let's do $1 million. Okay, we convert that into $2 million. Okay. We take that $2 million, and we're earning 5% on that. And so when we cash that out, all right, we have the 210 million. Okay, we convert that back into U.S. dollars. All right, so we bring it back into U.S. dollars, and we pay off the the $10, and we end up with that 53 cents of risk-free profit. And so with interest rate parity, okay, the interest rate parity, the investors should expect a return on the same return on similar risk securities in all countries. All right, so that purchase price parity, is the concept of, or the law of one price. So if we're looking at the same thing or the equivalent, all right, the same expected return, right, on a security, we can profit from finding this arbitrage or breaking of that rule. Okay. And so they're basically showing us, here's the exact calculation, but for an approximation, right, this one is a lot easier to calculate. All right, and so I'd probably write that one down for your preparation for the 6th exam. So exchange rate risk, the risk that the value of cash flow in one currency translated from another currency will decline due to the change in exchange risks. A natural consequence of international operations in a world where relative currency values move up and down. Right? And so here's the deal. We have an investment. Maybe that investment is not in stock, right? But maybe it's in a factory or equipment that is overseas. Okay, the value of that investment is going to fluctuate, right, based on the foreign currency exchange rates, right? And so that's the exchange rate risk. And so with short-run exposure, right, risk from the day-to-day fluctuations in exchange rates and the fact that companies have contracts to buy and sell goods in the short run at fixed prices, right? We can manage that risk, right, with two potential ways. Enter into forward agreements to guarantee the exchange rate, right? Again, foreign or forward contracts allow you to lock in, right, those exchange rates. Or use foreign currency options to lock in exchange rates if they move against you, but benefit from the rates if they move in your favor. With long-run exposure, right, long-run fluctuations from, and again, this is important, unanticipated changes in relative economic conditions. To manage this, okay, it's more difficult to hedge, all right, because you can't, there's not a 5-year futures rate, all right, to lock in, all right. And so what we're going to do is we're going to try to match the long-run inflows and outflows in that particular country's currency. Another way to do it is instead of using U.S. funds to invest into international companies, you use local banks, all right, or local countries where you're doing the foreign work, all right. You borrow in their countries, all right, to mitigate some of the problems because you're going to have to pay. So, like, if we're doing a factory in Japan, we use a Japanese bank to borrow the money, right, and we're going to have to pay that Japanese bank back in yen. And so we're basically doing all of our transactions in yen, right? And only when we actually get the money do we convert it for our records, or I should say, not only when we get the money, but we record that at year end when we do our financial statements because of the monetary principle in accounting, which says, hey, if you're in the U.S., you need to record everything in U.S. dollars, right? And so we'll have to convert that back. Translation exposure, income from foreign operations translated back into U.S. dollars for accounting purposes, just what I explained. Even foreign currency not actually converted, right? And so, you know, if we have a corporate, or I should say a subsidiary. We have a subsidiary that is operating in a specific country, okay, using completely that country's foreign currency, right? Whenever we have to do our financial statements in U.S. Reporting, we have to convert that into U.S. dollars. We can't use that foreign currency, right? So if gains and losses flow through directly to the income statement, all right, this would cause significant earnings per share volatility. That's why, all right, this is dealt with in other comprehensive income, right, as part of stockholders' equity. Accounting regulations require that all cash flows be converted at the prevailing exchange rates, okay, and currency gains and losses accumulate in a special account within stockholders' equity, all right, and that is cumulative income, or accumulated other comprehensive income. So managing rate risk, large multinational firms may need to manage the exchange rate risk associated with several different currencies, right? The firm needs to consider its net exposure to currency risk instead of just looking at each currency separately, right? Because you can imagine where, you know, the US dollar might be strong against one currency, but weak against another one. You know, if we can, you know, instead of trying to manipulate, all right, those individual countries, if we can treat them as almost counter-cyclical, right, and offset each other, similar to the idea of diversification. Right? We can hedge individual currencies, should be expensive and may actually increase the exposure. All right, so, you know, when we're hedging, all right, we might lose the benefit of that consolidation or diversification. When it comes to political risk, all right, you know, you see this all the time, especially in third world countries, you know, where a dictator comes in and overthrows the government, and you have a division that is doing work in that particular country, and they seize all the assets in that country. You're out, okay? And so this actually happened with Canadian diamond mines that were in they were in Africa, all right? And so, you know, there's these large expenditures that this Canadian company was making into diamond mines and the processing of those diamonds in Africa. Well, that country gets overthrown, and the new leader seizes all those Canadian assets and makes them state-owned. All right. Yes, it is criminal. All right, but it happens. All right, and so that's what we're talking about when we're talking about political risk. Changes in the value due to political actions in that foreign country. Investment in countries that have been unstable governments, or that have unstable governments, should require a higher return. All right, why? Well, because they're more risky, right? The higher the risk, the higher the return. Extent of political risk depends on the nature of the business. Right? The more dependent the business is on other operations within the firm, the less valuable it is to others. All right, so here's an example. We're manufacturing cars. All right, we have a company in Zimbabwe, okay, only because I like to say the word Zimbabwe, that produces a specific part made only for, let's say we're General Motors, for General Motors cars, right? And it's not a complete car, it's just a part for that car. Okay? If the foreign government is overthrown, okay, does the government want that company that makes this one particular part? It can't be used for anything other than a General Motors car? Not really. You know, so it's unlikely that the foreign government will, you know, seize those assets. And even if they do seize it, the value, the production value of that asset declines dramatically, because if it's seized from General Motors isn't going to turn around and say, oh yeah, hey, we'll buy that part from you. No, they're going to have that part made somewhere else, aren't they? All right. And so that's what they're talking about in this situation. The other, all right, natural resources development can be very valuable to others, especially if much of the groundwork has already been done. All right. And so, when we talked about the diamond mines, that's what I was talking about in this scenario here. All right. One way to alleviate that is, finance those things, all right, using local banks. All right. So if we would have purchased, okay, that factory, or we built that factory using Zimbabwe banks, all right, if the government, the new government of Zimbabwe overthrows and seizes, that factory, okay, well then we're not going to pay what we owe, right, to that Zimbabwe bank, are we? All right, and so everything is isolated or maintained in that particular country of Zimbabwe. I hope that makes sense. I look forward to seeing you guys next week. That's the end of this chapter.